You've worked hard to earn and save. Now it's time to make your money work hard for you. This is Empower Your Retirement with Frank and Frankie Guida of A Better Way Financial.
Financial 101, and I want to start with some basic retirement lingo. The 60-40. When people, how common is it just the 60-40? People just come to you and they say 60-40, right? That's what I got. So common.
It happens.
It happens. 60% stocks, 40% bonds. To this day, it remains the most popular type of portfolio. However, and we've talked about this before here on the radio program, big hit that came in 2022 because stocks went down and bonds went down. The 60-40 plan, in fact, is now up 15% 2 years in a row. So what can we expect from the portfolio in 2025? Here is Morningstar's Jason Kephart.
I think you always want to keep a longer mindset with a 60-40 portfolio. In 2008, it lost more than 30%. 2022 was down almost 20%. So this is not a one-year investment. This should be like 5 to 10 years minimum time frame. But having said that, yes, stocks are more expensive now than they were a year ago. Bond yields are starting to come down. So you might want to check your expectations a little bit. And another 15% plus return might not be in the cards, but then it might. But there are some risks, I think, that are really pertinent to kind of investors keep in mind in 2025.
So guys, thinking about what he said and where we're at with all of this, do you agree or do you recommend a 60-40 portfolio at all anymore? Do you go with something else?
Well, with what he said about taking a long-term approach, 5 to 10 years at a minimum, that part I agree with.
Okay.
Should it be 60-40 for everybody? Absolutely not. We don't paint everybody with the same brush here.
Right.
We make sure that because the biggest thing is someone's risk is going to vary by person. Not everybody feels the same way about risk. Someone might have lived through 2008 and been like, I lost half of my wealth and I don't feel comfortable having that level of risk again. Or
right.
through 2022, as they're getting close to retirement age and they're like, I lost so much money, I don't want to go through that again.
Yeah,
and there's other people who are like, well, I'm okay with that risk. I've seen it go down and I've seen it come back up, and I know that that's what the stock market does, and I'm okay with that risk. Right. So it's really on a case-by-case basis. You want to make sure that for each individual person, you're setting up their portfolio in a way that they feel comfortable with. Investment 101, never lose a client more money than they feel comfortable with.
Right.
So it's so important to make sure that when you are meeting with somebody, you're understanding exactly how they feel about their personal risk tolerance so that you can make sure that they don't ever lose more than they feel comfortable with.
And everybody feels differently about the stock market. You have people that are, very, very pro stock market. They want to have all their investments in the stock market. And then you have people that are very, very conservative. No, I don't want to have anything in the stock market. It goes down, that kind of thing.
Yeah.
So really with us, it's about education. We want to help people understand how the stock market works and why, probably should have a part of their portfolio in the stock market. And the reason is because over time, it's been the best return on investment out of any pure investment.
Okay.
Sometimes I have people say, well, what about real estate? And I'll ask, like if I'm at a seminar or something, I'll ask people in the room, hey, who owns rental properties? And a couple of people will raise their hand. I'll say, well, you agree with me that real estate, rental properties, is not really a pure investment. It's basically a business. You have to work it. You have to, see if people are eligible to come into your apartments or whatever. You have to, fix things when they break. All of these different. It's a business. It's not really just an investment. Where you can just take your money and put it in. So when you look at over time, I've never seen anything that's outperformed the stock market over time as far as average return. Then we look at and we try to explain to folks, the way you invest when you're in your accumulation stages of life should be different than the way you invest when you're in your retirement years or approaching your retirement years.
Right.
And then I explain why. I take a look at, for instance, the S&P 500 from the year 2000 all the way to the year 2025. And I usually show from 2009 to 2025 the tremendous amount of growth. And people are like, wow, that's tremendous double-digit growth. Yeah, that's wonderful. But then I also show them 2000, 2001, 2002. Market dropped 50%. 2008, the market dropped 50%. And I say, when you're going through your accumulation stages of life, that doesn't really matter too much. yeah, you see your funds go down. But if you're going to keep the funds and save them for retirement, you're looking at, you have a long range, thought of what you're doing with this money. So you can afford those dips because of, markets always come back.
Right.
But if you're in your retirement years, it's another story. You look at 2000, 2001, 2002, market goes down 50%. If you have all your money in the stock market and you're retired, your money actually goes down by more than 50%. And the reason is because you've put that money there to supplement your retirement income. So you're taking money out.
Yep.
So your money's going down at a higher rate than 50%. And even when the market starts to come back, you're not going back at the same rate of return. You're going back, you're still taking out money. So you don't have the same trajectory up. And then 2008 hits again and boom, what happens? You're still taking out money and the market's going down. You could be in danger of losing your money, of running out of money. That's an issue. So what we try to show folks is, yes, you need to have market money in your portfolio and you need to have safe money in your portfolio. And the reason you do that is for when the market goes down, you don't want to sell the market money because then you're going to tie in the losses. What you do is when the market goes down and you want to draw income, you take it from your safe money. And when the market's up, you take your income from the market money. So this way you're always buying low, selling high. And for folks that are concerned with, not wanting to see their money go down, what their risk tolerance is and all, we show folks that if you have all of your money in the market and the market goes down by 50%, what happens to your portfolio? Well, it's going down by 50% as well. But if you have half of your money in the market and half of your money in a safe money investment that doesn't go down and the market goes down by 50%, your portfolio goes down by 25%. Okay. So then we say to them, are you okay with that? Or, where do you stand on that? Some folks are like, I don't want to see my money go down by 25%. Well, that's simple. Just put more money on the safe side. Then you have other folks that say, I really want to get the best return I can. Well, then put more money on the market side, but make sure you have enough money on the safe side to take care of your income during the times when the markets go down. So if you're thinking to yourself, I'm a little uncertain about my portfolio. I'm not sure if the markets crash. Am I going to be in a good place? If you're concerned about these things and you're 55 or older and have saved $500,000 or more for your retirement, give us a call at 610-440-3722. That's 610-440-3722 for your complimentary risk analysis right now for the next 5 callers.
So we recently met with some folks who were in this type of situation. They wanted to better understand what is the risk in their portfolio, what is the return that they've been earning within their portfolio, and make sure that they can set themselves up for retirement in a position where they can try to get a portfolio that's within their risk tolerance and getting the returns that they're looking for over the course of their retirement years. And what we did is we looked over the past 25 years to see how they were doing. They were in the early 60s and they're both working full time, looking to retire in the near future. And they were wonderful people. They loved being outside, gardening, golfing, and traveling. And, they just great salts of the earth people. And we wanted to be able to help them to be able to retire, to be able to get the income that they needed over their retirement years. But it started out with their portfolio to make sure that they could earn the rate of return that they needed to supplement their lifestyle in their retirement. And they didn't have a very high risk tolerance. They didn't want to take a lot of risk in their portfolio, so they wanted to keep it somewhat, conservative as far as the risk goes. So we wanted to make sure that we were keeping them within a low conservative risk tolerance. And their current portfolio was in a low risk tolerance, but it was only averaging about a 4% rate of return since the year 2000. And we said, well, let's try to make sure that we can optimize the rate of return while keeping you within that low risk tolerance. And from 2000 on till 2025, it would have earned about a 7.4% rate of return with our recommendations. So on the $1.1 million that they had saved, that's an average of about $36,000 more each year in return that they can use.
That is significant. When you can have the same portfolio and average $36,000 a year more, I would say that's very, very significant.
And compounding that annually over the next 20, 30 plus years, this can make a huge difference in retirement. And so being able to successfully show them how much income they can live on in their retirement and when they're able to financially retire made a huge impact for them. So if you want to have your portfolio reviewed and really learn what is it that you have within the portfolio, what is the risk of the current portfolio, what are the returns of the current portfolio, as well as different options you have to make sure that you're optimizing your retirement and getting the most out of your retirement, you need to give us a call for your complimentary retirement risk review. For the next 5 callers, this is going to be complimentary. So give us a call, 610-440-3722. If you're 55 and older and you've saved $500,000 or more for your retirement, give us a call right now, 610-440-3722 for your complimentary risk and return retirement review, 610-440-3722, or visit us online at abetterwayfinancial.com.
Thanks for listening to Empower Your Retirement with Frank and Frankie Guida. To learn more, visit abetterwayfinancial.com.
By contacting us, we'll review aspects of your retirement portfolio to include suggestions about how best to utilize estate, tax, and retirement planning strategies and other financial services, or if changing management styles is appropriate for your specific needs and objectives. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendations to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. A Better Way Financial is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company. Any client experiences discussed during this show are unique to that client, and they are not meant to imply or suggest you will experience the same results. Advisory services offered through A Better Way Financial. Insurance offered through licensed professionals at A Better Way Financial. Pennsylvania Insurance License number 301779.